There are 5 stocks I wouldn't buy when the stock market hits bottom.
2020 and 2021 was a great stretch for stocks as unprecedented money printing from central banks and stimulus from world governments to combat the economic effects of COVID-19 caused a financial bubble that sent US stocks up nearly 70% in 18 months.
Now, nobody knows for sure when stocks are going to bottom. As someone who headed an investment research company for nearly a decade, there are a handful of stocks I would avoid during the next market cycle. And if you don't want to miss any of my analysis in the future, make sure to follow right here.
The first stock I'd avoid is Chinese e-commerce giant Alibaba, as while the stock is cheap on a historical basis, I expect the crackdown on Chinese tech stocks to continue as Xi Jinping reigns in the country's e-commerce, social media, and gaming industries.
And considering that WOULDN, the Chinese version of TikTok, is launching its own e-commerce platform, Alibaba's competition has never been stiffer.
Next on my list is movie theater stock AMC, as while the stock had a great run during the meme stock frenzy in early 2021, I view that as a one-off event that won't repeat as it came after massive stimulus spending in the euphoria phase of the last market cycle.
Considering movie theater sales peaked in 2002 and is in secular decline, there's little to like about AMC.
Third on my list isn't a stock, but rather the ARK Innovation Fund, as while I wrote glowingly about her Tesla call in my book, A Beginner's Guide to High Risk, High Reward Investing, Cathie Wood's ETF is full of pandemic winners who saw a one-time earnings boom during COVID, meaning these stocks and her ETF will likely never see new all-time highs.
Follow for part 2.